Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, head of content and program at DealCatalyst. Joining me today is Kunal Shah, VP Capital Markets Execution at Upgrade. Kunal, pleasure to meet you. Thank you for your time today and looking forward to this episode.
Absolutely, Todd. Thanks for the invite and looking forward to having this conversation with you. Super excited to.
Well, as always, thanks for your time. To kick off with, I'm very familiar with Upgrade and kind of your history, and my background has certainly been running fintech events prior to joining DealCatalyst. But for those who might not be as familiar or may think of Upgrade through a certain lens, what does the business look like today? How diversified is the product offering? Maybe just kind of start with who is Upgrade in 2025.
Yeah, absolutely. No, Upgrade, the way I would categorize as a um, fintech neobank, which has been really co-founded by industry veterans and the financial services ecosystem. This is not their first endeavor. They have had past companies which have also gone public. The leadership team possesses a very strong understanding of the ecosystem to build the right products for both sides of the network. When you think about it, the consumers as well as the merchants, dealers, the users of the financial services product. The platform is a multi-product platform. So we have a slew of products. So we have our personal loan product, we have a card product, we have home improvement, indirect auto, buy now, pay later, which came through our acquisition, as well as we have the rewards check-in and savings program for the consumer. So the way I would describe Upgrade is it's a neobank which possesses a whole slew of platform-wide financial services for an obligor, as well as payment and lending products for our partners, which would be on the dealership, contractors for home improvement, and then enterprise merchants, which predominantly is travel, but we're expanding also in retail categories in that particular business line. On the network side, it's a very well developed network. We have life to date done about just $40 billion in origination. 7 million plus customers who have worked with us throughout this journey. On the home improvement side, I would say we have about 2,000 merchants life to date who have used our product, which is a newish product for us, just launched in 2022. The auto business is actually even newer than that. That product was launched in late 2023. The capital partnership side, 200 plus partners who work with us, and the full flurry would be financial institutions, hedge funds, asset managers, institutional sources of capital. That's where I predominantly spend the time, but the company is focused across the stack and really leveraging that network and supporting through technology the financial services which we provide.
And that's where we'll spend most of our time here today is kind of on the funding partner
Hmm.
side of the equation. And I know that your background is from Uplift, which I believe is the BNPL platform acquired by Upgrade. And so I'd be curious, given your time there and now at Upgrade, how different were the conversations, say, a handful of years ago, 3, 4 years ago, when upgrade and uplift were separate, to what those conversations look like today, and how have they evolved?
It's a very good question. So the way I think about it is, in my days at Uplift, which now is rebranded to FlexPay, the conversation were more focused on one product, which is like travel specific buy now pay later, and the investors were curious more so on consumer behaviors from that perspective, merchant adoption of the product, things like that. Versus when I think about like the current ecosystem for Upgrade, it's a diverse product mix, right? So we are working on 5 different lending asset classes. So the conversations more so gets deeper into loan performance across the stack, portfolio diversification. How does the duration and a yield really match from an investor category or a demand perspective? So it's a bit evolved and a deeper rather than just focusing on one or two
Yeah.
specific categories in that product. We work with like a whole slew of investors, as I mentioned, right? So we support credit unions and regional banks in their asset liability management because we also provide reward checking account and we also do have lending products where they could invest in. We also work with multiple banks where we have either structured credit facilities supporting the growth of a business in the early days, as well as those banks helping us in ABS transactions. Um, so it's a bit deeper and evolved rather than like very centric in one category, is how I would define. But still, FlexPay is very near and dear to me. I have spent a lot of time there, so really enjoy that product. And again, it contributes very strongly to the business, both from a long-term strategy perspective as well as from a P&L standpoint.
So when it comes to, you mentioned a couple of things in that answer, ABS, structured credit facilities. I mean, ultimately, what does the stack look like today? And is it based on the different type of funding partner? Credit unions and banks will look to do this type of structure. Credit funds will look to do this type of structure, or is it more based on the loan product? Like, how does the mix and match of funding partner and product on the funding side, how does that work, and what does some of that look like today?
Yeah, so it's a very rich topic, and the way we have tried to solve for it is we finance our origination through like a multi-layered capital stack. And the way I think about it is everything is possible. It just depends on what the partner is trying to solve and what our abilities are to offer that structure or a partnership proposal. So the way I think about it is like we work with banking partners to originate as well as finance on the balance sheet. And when you think about like financing on balance sheet, we work with whole slew of multinational banks based out of US, European banks, Japanese banks, etc. Those tend to focus more on like the structured finance warehouse style, like the plain vanilla warehouse financing. We also do have forward flow agreements. So we work with our partners in forward flow and whole loan purchases, where they see the right viewpoint in duration and yield which they could extract from this particular credit assets. We also do have an ABS program. We launched that ABS program back in 2018 under Upgrade Receivables Trust Shelf. And we have been quite active in that market, actually. We launched that program in 2018. We recently did a transaction last year in November of 2024 called UPGR 2024-1, which was for our unsecured consumer personal loan business. And there was about $300 million in size. Very strong demand and interest from investors from the categories I mentioned above, but also asset managers, insurance capital, things like that. We have been quite active these days in the ABS space, maybe a bit different structure, what we call as a structured pass-through, working with like a one major bank. And we've been coming to market every 1 to 2 months. Again, the size varies from a transaction to
Hmm.
transaction on a variety of factors, but we are doing about 150 to $300 million in size of structured pass-through for the unsecured consumer PL product. And we are actually evaluating to include that strategy for our new business lines as well. So when you think about our home improvement, auto, and FlexPay, we're also trying to evaluate a similar funding strategy, as we see like those markets have developed and matured a lot and are actually quite attractive to include it in the funding mix.
So how maybe a bit of a broader question on the funding mix and different diversified mix of funders. I mean, how important is the element of diversification? Because if ABS markets dry up or some other piece of the funding equation becomes, let's just say, a bit harder to get some of these structures done. I mean, how big and how important is it to have this multi-layered approach to your capital stack?
It is very important, and that is something which comes from two factors which I mentioned earlier. Like one, the leadership team's awareness and ability to execute, and second is being very mindful in developing that resiliency from redundancy standpoint. So the way we really think about it is at each point of I wouldn't say failure, but like capital transactions, possibilities of
Mm-hmm.
different outcomes, you want to build in that redundancy. So the way we think about it, we have multiple warehouse financing. We work with about a dozen different banks to really support the balance sheet. We have 200 plus active investors who participate in the program via purchasing a specific category of assets, whether they like a duration, whether they like the credit segment, things like that. And then when I speak about ABS, like the way we try to really mitigate the thought process of that drying up is we produce short to medium term duration risk assets. So that really actually fits in variety of different investors from how they try to mitigate the interest rate volatility. So we actually fit in really well in that categorization to provide assets, and that becomes very important. So I would really hone down on the fact that having a product mix on the lending side, but also on the deposit side, which is rewards and checking account. Also, our expansion into recently we launched two new products in our auto business, which is gap insurance and vehicle service contracts. So ability to launch those products, having a diversified product mix, and on top of it, each of those products having a diversified funding mix is something which we really focus on. And that creates a differentiated mode. It takes a while to build. It's not something which does
I,
happen
I presume so.
very, very quickly. But once you do the right things, the long-term business perspective becomes quite clear and resilient.
Is there, looking at the, obviously this will probably depend on the funding partner, but like we've had a volatile year.
Mhm.
Um, what are some of the key questions that your funding partners are asking you about? I know, granted, if it's a new product, it's probably more about the new product, the rollout of the new product, what some of the key features of that are. But say it's one of your mainstay products, in a year like this, are there particular questions they're coming in asking about? Like, what are some of those key things the investors are coming to you and asking you about?
It is certainly quite interesting times, to say the least. I think the pace at which technology is evolving and the growth which I think platforms have seen, the questions have um, been focused on specific products, but also like in general macro environment. I think has been the similar theme which we see from multiple investors. But I think at the core of it, it still remains the same. Like the questions still revolve around yield, duration, credit performance, how you are thinking about solving for underwriting risk, pricing risk, regulatory and compliance perspective and different asset classes, things like that. So that still remains the core approach which investors are trying to understand and really navigate to that in the recent time period. One particular thing which I generally think is advantageous in our seat is, given a different product offering, we're able to guide them in different ways. So let's say if an investor comes and really wants to solve for a yield, but is demanding a medium to long-term duration in like 2 to 3 years, we have a product suited for that. Like, hey, we have auto and home improvement, which is a bit longer on the duration side, but stable credit yield performance. If somebody is really looking to evaluate like risk rewards and wants something on the short duration side of the things, that's where our FlexPay products come into play, because it's a quite short duration asset class and really
Yeah.
supports the appetite for a given investor. So overall, I think like the thesis and the questioning still remains the same. It's just like what we're trying to bridge and how we can really support them with a variety of different offerings which we have.
So two particular investor groups, have clearly risen to, I guess greater prominence the last couple of years. One is, the broader term private credit, which certainly, I'll put in the bucket of, credit funds for this conversation.
Hmm.
And then the other group is insurance companies. And there's certainly a lot of melding between the two of those, with insurance companies and asset managers owning insurance companies. But like, when thinking about the increased amount of capital coming into the space, I mean, does that change kind of the dynamic and give you guys kind of the power in some of those conversations with all this extra access to capital? Or is it all about what you were just talking about, which is matching the right investor with the right product for the right duration or yield or whatever they might be looking for? Like, does the increased interest from these different types of investors, how does that play out when there's so much more capital coming into the market?
Yes, certainly is a short answer. Um, and here's where it gets a bit more interesting, right? Because when you think about like the broader trend across the asset-based market, there has been more capital being deployed by insurance providers, and particularly in like structured transaction
Mhm.
focused on consumers. So like that's positive, and I think like that's really benefiting not just us, but like in general, the ecosystem. Now, it gets a bit more interesting with upgrade, just because with the very senior leadership being gone through the cycles and understanding of how to develop businesses in that cycle. So what we see is that duration aspect is still something very important because investors are trying to match the liabilities to invest into a
Yeah.
particular asset from a cash flow standpoint. But our ability to match that duration based on demand, not just focus on like, hey, we have this unsecured consumer personal loan as the only offering, gives us this differentiated edge. It's like, hey, we have one on the duration side, two on the yield side, abilities to navigate both conversation, what the investor is trying to solve for. It's not generally mutually exclusive, but it also has a quite different needs from a time to time standpoint. And if you can offer that, it's quite commanding. And that's why we see a lot of interest and demand in our recent shelf. And as we are starting to evaluate, including ABS as a funding mix in our new products, which is home improvement, auto, and FlexPay. I think this partnership is going to be quite long-standing and mutually beneficial to both counterparts. One, like insurance provider, as well as net new entrants who enter the ABS space, as well as for Upgrade as a platform, because they would get the diversified product offering from one issuer or a one sponsor.
When you launch a new product, like the auto or home improvement loans, um, how long does it take to go from launching a new product to, kind of ABS markets? And, you guys might have a bit more of an advantage than say a startup fintech or a startup lender.
because they're trying to prove their business model. You guys have a business and you're adding a product line to it. But what does that journey look like from inception of a product to ultimately what I would think is probably the the key funding piece, which is reaching the ABS markets?
Yeah, and it's a very rich topic. I think it depends on variety of factors. Like market volatility also plays into it on top of like the maturity of the platform. So I'll give you some facts about this question. So like one is when you think about our home improvement business, that business was launched in late of 2022. And by December of 2024, we have done already $1 billion in origination. So like
Yeah.
that scale and ability to get to that scale is something which comes with A, platform's abilities, and B, ways to navigate the execution risk which comes along. When I take a similar example for auto, we actually beat our own benchmark in that product. So we launched that business in late 2023, and very recently, actually, we just announced in June time period, we have already crossed $1 billion in origination for that business as well. Now, those two businesses are a bit different, right? Like auto is about 50% of the ABS market from an issuance standpoint, so quite mature and a commoditized product.
Yeah.
Home improvement, a bit newish category per se, and the consumer landscape. And when I include on top of it, like the FlexPay component to it, which is an acquisition, which is where I spend most amount of time, which was in July of 2023. So when you see from like different viewpoints of those asset class, the timing of an ABS is one factor. The second factor is like inclusion of that strategy in the funding mix. So can we do an ABS transaction for auto this year? Absolutely, yes. We probably can come to market and do an ABS transaction for that product. Can we do that same thing for FlexPay as well? Absolutely, yes. How do we prioritize the
Yeah.
rank ordering internally becomes more critical for us, because what we're trying to optimize is when we evaluate an ABS for a particular new asset class, execution is one front. How we are bringing in that product and portraying it for investors, demand, as well as not just one and done, but how does that become as like a recurring ability for people to invest in, is something which we also focus on. So generally, I would say anywhere from 2 years, it's a great conversation to add in. But from there on, it just varies on different factors which you're trying to optimize on.
Are there, obviously we've talked about kind of the questions and, what investors are coming to you about your products or yield duration, whatever that might be. Is there a common worry that they're bringing up, whether it be macro because we're in a bit of a volatile period now, resilience in the capital stack? Like, what are some of those common worries that might come up in these conversations as you're either building out new products or your existing product set?
It- It's a good question. Like common worry is very broad, right? It's generally hard to categorize. So I wouldn't say there's one particular factor, but there's a general conversations which we try to navigate. But the one theme which always seems to be the center focus is the intent and the ability of a given obligor when you are thinking in from credit extension perspective. Are you underwriting the right risk, and are you pricing that risk appropriately?
Yeah.
So when you think about our viewpoints, like investors tend to focus on like when we say a financial health of an obligor, is this appropriately priced, or is this something which people are having the right process and controls to manage and extend credit? We do heavily focus on um, really optimizing for the headwinds and then really trying to manage the tailwinds. Um, and it's a balancing act. It's not a right answer in any shape or form, but it's really a balancing act of how any particular worry which comes in the business you navigate. One example I can think about is I actually was part of the COVID time period when things were a bit more uncertain. And when you are in travel industry, you probably are impacted a bit more than the
It's like
usual.
the event industry.
Exactly. But we try to optimize for what worked in business at that point in time. So like we were travel buy now, pay later, and navigating travel itself is one of the worst situations which has at least happened in the past many, many decades.
Yeah.
And when you come on the other side of it and you're still thriving and growing, you at least have a recipe of how to manage and navigate. Maybe not in every replicable situation, but at least somewhat awareness of how to deal with that situation.
A common theme that has come up, at least the last year or so, given some of the changes in the administration and kind of the maybe the rolling back of some of those consumer protections. Um, is there a worry that maybe investor expectations are starting to shift? That higher priced lending is starting to come back into the market if some of these let's say guardrails are starting to be pulled back, or have states kind of stepped in and kind of filled maybe the void being left by the CFPB and others. How do you guys think about some of those dynamics beginning to play in the market? And does that filter through to some of the conversations you're having with funding partners?
Yeah, it's a very rich topic and certainly a good focus this period of time, given the administration's mandate. I think there's some anxiety, is the right word I would describe it, when you think about the agencies like CFPB losing authority. Like that certainly does warrant some discussions of predatory lending. Like, would that something which really would come back into the market? And the way we have generally thought about it is like ability to protect consumer in the robust fashion is important, whether it's reporting to credit bureaus, whether abiding by the state and federal regulations, it's still very important. Those things are not good to have. Those are necessaries part of the business. Like that is something core to the business. And when you take that position, investors appreciate that. Investors certainly have a positive viewpoint because that is something which is not thought out from trying to optimize on regulatory debacle or regulatory changes. It's trying to build a business from a long-term standpoint. Like, so that's how we have generally viewed it. We do see some ingrown focus by strategic investors, and that's where I think like having that transparent conversation and positioning yourself as someone who is trying to build something for the long term really differentiates, and those partnerships actually become quite fruitful rather than again going back to my point of like trying to optimize for where things may be opportunistic just in the short term versus thinking about growing this in the right fashion from a long-term perspective.
Fintech lending has kind of evolved a fair amount the last decade or so. And I think, we've now reached the point, and I'm curious to get your thoughts on this, and kind of, have we moved past the, the monoline lender, and that, I'm going to build a business just on consumer or just on BNPL or just on something else. It seems like we've kind of moved a bit beyond that. You guys obviously are a great example of that, because ultimately diversification in the end is the key. And hearing your answers to most of these questions, both on the funding mix and the product mix, ultimately you need multiple lines of business and multiple entry points for customers and multiple products to sell to investors.
Yeah, it's certainly evolved, but the again going back to the motivation remains still the same. Like if you take like GFC as a one fact or a point in time event, those motivations still, I think, remains the same. Like banks have generally pulled back from certain consumer categories, so there
Yep.
still remains an opportunity for fintech providers like us to really capitalize on that. And it depends on how, like rather than why, it depends on how the providers are capitalizing and providing the right services to the consumer. Like the basics still remain the same. So when you think about Fintech's ability to offer a competitive product to a consumer, that still is the solution which you need to optimize for. Now, whether it's a one-click solution or whether it's a review-based solution, I think that's a varying factors you're trying to figure out. We have products where we would really try to optimize for a quick decision, and we have really large dollar amount credit products as well, where quick decision is not the center focus. The right decision is the center focus. So I think it's the balancing act of both which you try to navigate when you think about a fintech provider. Competition has increased. Like the one factor which is happening is like when you think about that diversification, there are many peers of ours who have focused on one particular product, and there are many peers of ours who have taken a similar-ish trend, maybe not to the same breadth as us, in providing that financial services. But if you focus on the main aspects, which is better consumer experience, responsible credit outcomes for the consumer, then I think you still are going to develop a defense-worthy business in many cycles to come, as well as you really navigate the adoption of AI and fintech into the broader financial services ecosystem.
It's, it's funny you mentioned AI. I mean, one of my final questions before we get to maybe some of the fun questions is, credit in some ways has become very simple to access from a experience standpoint. Like you said, I mean, some of the products, if they're longer term or higher amounts, there's obviously going to be a bit more checks in place for that. But ultimately, like, have we made access and the experience so or too easy at times, where either it gets people in trouble that they're taking on too much, or maybe even gets lenders in trouble that they're lending too quickly and too much because maybe the data is not always matching up, the credit reporting, and like, how do you think about the ease of credit access, the technology piece, and obviously the risk element that underpins all of that?
Oh boy, that's fully loaded question. Um, Let me answer like three factors to it. The first one is like the AI, machine learning, and the use of technology. I think that's where fintechs have done fairly good,
Yeah.
because a lot of the building blocks from very early days were based on that, versus I think legacy banks and systems where that wasn't the core part of it. And I think like those banks are also catching up, but there is a still a lot of catch up to be done yet. Versus when you think about the fintech ecosystem, a lot of that focus has been the primary way of solving that ease of credit and customers' demand. The second part is, I think, the few clicks, it's a bit intertwined. And when I say it's a bit intertwined, um, going back to my point of intent and ability really becomes quite important.
Yeah.
Um, when a consumer is trying to book something on United, and if you can make it more accessible for the consumer to book, few clicks is great. Like it's a great experience because the funds are being dispersed to the merchant and the consumer is getting the flexibility of a payment. And if you can make that more efficient, there is more room to grow. Versus when you think about a product where you're extending somebody to help build a roof and a kitchen and a pool, maybe you need more intertwined and engaging experience to navigate that product. So it's probably not a few clicks, but something more involved than that. Like that's how I think we think about balancing both of those items, like that intent of what is being solved for and the ability to manage that risk, whether you're dispersing it directly to the consumer, directly to the merchant, things like that. And then the third is very interesting. When I think about all of these things coming into play, um, if you can parse that risk and still optimize for the opportunity, which is consumers' ease, whether it's instantaneous decisions or the proper review, such that you can weed out the bad actors, I think you still do build a very resilient business. And that's generally how we have focused on building Upgrade.
So we have just a couple minutes left. I'd like to end with a little bit less heavy questions.
This has been great. This has been great. Thanks, Todd.
Yeah, favorite sports team and or hobby.
Sports team. I'm not sure the viewers are really into that sport, but I am a huge cricket follower.
I
I
had a
do
feeling.
love, I do love cricket, given my background. Um, there is a couple of teams which I follow, like Indian national team is certainly one. But there is a team which plays in Indian Premier League, which is equivalent to like an English Premier League for football, but this is
Mhm.
for cricket. And there's a team called Chennai Super Kings, which is one of my favorites. Have been to many of those matches and really thoroughly enjoy those. Hobby. I do love cooking periodically, not all the time. My wife may have a different stance on it, but I do love cooking specific sweets. I have a sweet tooth and I enjoy cooking them.
What is one book that you'd recommend reading?
Very good question. Capitalism Without Capital. It's a book by Jonathan Haskell and Stian Westlake. It articulates very nicely of how the world is evolving, particularly in the capital markets world, if you really want data points, but also in general, how technology is supporting the transmission of data, money movement, things like that, rather than, I think, how generally people are ingrained with the thought process of capitalism. So it's a very rich book.
Tell us one surprising thing about yourself.
Oh, this is a hard one. It is a bit quirky. It's a bit quirky. But I've been following this for the past decade or so. Initially alone, but now with my wife. Every New Year's Eve, we'll try to pick a spot, which is a net new spot we have never been, and try to spend the New Year's Eve in that particular city. Again, we've been doing this for a decade. The goal is to
Interesting.
continue for some period of time, as much as we can.
Most exciting part of your job.
Oh, this is an easy one. Working across multiple asset classes. I think it's hard to find many companies which offer that breadth of products. So certainly working across the multi-product dimension and then multi-capital market solutioning, whether it's warehouse financing, ABS, forward flow, some structured form of transaction. Love doing that, building relationships, and particularly building with the fintech pioneers. When you work with the pioneers in the industry, it does give you a very positive outlook to many things.
And then finally, one prediction for the next 12 months.
That's a rich one. I think it goes back to the earlier point which you were noting. So continued growth in the asset-based finance by increased penetration from insurance and new entrants probably will continue. I think like there is one hypothesis where the lines between LPs and GPs starts becoming a bit blurrier. Certainly as they start looking for more attractive assets and stable and competitive yields. So I think like that is one thing. Not sure if that would truly come out into next 12 months, but I think like we'll start seeing some trends going in that direction, certainly in the next 12 months.
Well, Kunal, I really appreciate your time. This has been a fantastic conversation. So thank you. And continued success to you and the team at Upgrade. And for the audience, just as an FYI, we are hosting Upgrade's co-founder and CEO, Renaud Laplanche, at our ABF conference in September. So if you haven't yet got your tickets for that, make sure you get them. And you'll hear, as Kunal has mentioned, from one of the pioneers in the fintech lending market.
Awesome. No, thanks, Todd. Really, really enjoyed our conversation and appreciate the time.
Of course. Thank you.
Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.